Hello everyone, this is Marie Rosado, your South Atlanta Realtor at Better Homes and Gardens Real Estate Network Brokers. I am creating this post for buyers who might be thinking of buying in the next 3 to 6 months. I thought that this article that we are about to go over will answer some of your concerns on whether it will be harder for buyers like you to get a mortgage amid the coronavirus pandemic. I hope that you stick around and take a listen. On a side note, I do want to share that the reason why I post videos is because I truly believe that a well-informed buyer and seller make the best real estate decision. If you like this video, please feel free to share, like, comment, subscribe, and smack that bell to get notified on future posts. When you are ready to either buy or to sell your home, feel free to reach out to me through my site at marierosadohomes.com. Now let's go over the article.
Borrowers will find it harder than ever to get a mortgage this spring, and here's why. This article is written by Claire Trapasso on May the 4th, 2020. I will make sure to leave a link in the description box below. The article says, it's a stark good news, bad news story. The good, the lowest mortgage rates in recorded history are motivating many would-be home buyers and refinancing homeowners to seek out a loan. The bad, amid the economic upheaval caused by the novel coronavirus, it's become significantly more difficult to get one of those loans. As more Americans are getting furloughed and pink-slipped, lenders, ever mindful of the housing bust of more than a decade ago, are requiring higher credit scores and larger down payments. Some have ceased making loans they consider riskier, such as those for self-employed borrowers and real estate investors, those that require lower credit scores and down payments, and those for larger amounts, such as jumbo mortgages, or they may be jacking up fees to make the loans prohibitively expensive. This will mean that some folks who still want to go ahead and take advantage of those record low mortgage interest rates won't be able to do so. That's the lowest it's been. Rates fell to just 3.23% on a 30-year first fixed rate loan for the week ending April 20th, according to Freddie Mac. That's the lowest it's been since Freddie Mac began tracking rates in 1971. Yet the availability of mortgage credit dropped 16.1% in March, a clear indication that lending standards are tightening up, according to the Mortgage Bankers Association Mortgage Credit Availability Index. That's the lowest level of the index since mid-2015. Lenders have reasons to be cautious. Roughly 7% of mortgages were in forbearance as of April 19, according to the MBA. Experts predict the number of homeowners unable to make loan payments due to economic hardship will rise as the downturn drags on. Another wave of foreclosure may not be far behind when forbearance periods end, typically in 12 months. About 5 to 20% of prospective borrowers could have trouble getting a mortgage due to the higher standard, says Javier Vivas, Realtor.com, Director of Economic Research. Those numbers will likely rise as the recession worsens. Unemployment could top 20% in some worst-case scenarios, and even those who hold on to their job could see their salaries fall or lose bonuses, overtime pay, and side gigs. Many of these folks have already ruled out immediate plans to buy a house. Some lenders are requiring higher credit scores. Many folks with average credit scores who may have even been pre-approved for a loan at the beginning of the year may have trouble qualifying for a loan in today's environment. Before most folks have heard of COVID-19, credit score requirement started at just 580 or lower in some cases. These were primarily for government-backed loans such as Federal Housing Administration, U.S. Department of Veterans Affairs, and U.S. Department of Agriculture mortgages. Now, most lenders issuing those loans are asking for credit scores starting between 640 and 680. Most JP Morgan Chase borrowers will need a minimum 700 credit score and 20% down to qualify for a new loan. There is at least one exception, the Dreammaker program targeted toward low and moderate income and first-time home buyers with lower credit scores and down payments. The bank was the fourth biggest mortgage lender in 2019, according to Inside Mortgage Finance. Due to the economic uncertainty, we are making temporary changes that will allow us to make closely focus on serving our existing customers. A Chase home lending spokesperson said in a statement. Flag Bank and Better.com are also now requiring borrowers to have higher credit scores. Flagstar is asking for 660 scores for FHAs and 680 for VA and U.S. Department of Agriculture loans. Better.com is asking for a minimum of 680 scores. Previously, lenders' minimum scores were 640. During this crisis, Navy Federal and Better.com have temporarily stopped offering FHA loans altogether. Now, I do want to point out that based on my conversation with some of the lenders that I'm working with, they have tightened up their requirements a bit, and the majority of them are currently focusing on assisting homeowners to refinance their home. They're not really focusing now on providing FHA loans because of that risk mentioned in this article. I do want to point out that if you were pre-approved to get a loan prior to COVID-19, I would suggest that you consider to get another pre-approval from your lender again to account for any loss of income or any change in employment, just so you could have be pre-qualified again. So I just want you to keep that in mind. And the article goes further on to say that fewer jumbo mortgages are being offered. Fewer lenders are offering jumbo mortgages during this crisis. That's because for these larger loans, there's more money on the line for the borrowers to go into forbearance or default on their payments. Jumbo loans typically start around $550,000 and go up to just over $765,000 in some of the nation's most expensive real estate markets. Banks don't like to keep loans on their books because it ties up capital they could be using to make more loans. So they typically bundle up mortgages and sell them to investors in the secondary mortgage. But jumbo loans aren't backed by Fannie Mae and Freddie Mac. So investors consider them risky, especially in a time when many folks are going into forbearance and not making payment on them and aren't buying. That makes banks will have to hold on to these loans if they can unload them, which limits how many new loans they can make money from. So some lenders aren't doing them, at least for now, or they're raising fees to give themselves a financial cushion against a potential default and discourage folks from taking them. It goes on to say that Wells Fargo is still offering the loan to buyers, but will refinance jumbo loans only for its customer with at least $250,000 in asset at a Wells Fargo bank. Um, so it goes on to say that self-employed gig workers and real estate investors may have a harder time. Self-employed gig workers and real estate investors may also struggle to obtain a mortgage. Many of these are the folks who would normally apply for a non-qualified mortgage because they need to verify their income with bank deposits instead of more traditional W-2 forms, pay stubs, and tax returns. But these mortgages are deemed riskier, and investors in the secondary mortgage market have little appetite for anything but the safest investments. So fewer lenders are offering them, or they're upping the cost of these loans to account for the risk. Those extra fees or charging additional points or a backhand way of not doing those loans, says lender Andrews. Plus, some lenders are discounting self-employed income. That means they might count only a portion of what these borrowers make last year, perhaps 70 or 80% as qualification for a mortgage. Some aren't factoring in bonuses, expecting that these folks will earn less money this year with the economy in turmoil. The discounting of earning also boosts debt to income ratios, another factor that goes into whether someone gets a loan. Lenders traditionally like to see less debt and more money coming in. Lenders are doing additional income verifications. With folks losing their jobs or getting furloughed every day, lenders are also waiting until the last minute to verify employment and income. So instead of checking in with the borrower's employers 2 weeks or 10 days before the closing, they're doing it a few days before or even on that day. It can be catastrophic if someone lose their source of income right before buying a house, says longtime mortgage lender Jason Lerner. He's a vice president at George Mason Mortgage in the Baltimore suburb of Lauderville. Erica and Ian Rasmussen were set to close on a 4-bedroom, 2-bathroom home in the seaside town of Greenport, New York on Long Island. The couple, who lived in nearby Port Washington, wanted to use the century-old home as a vacation home and short-term rental property. But a few days before the closing, Erica, 38, was laid off from her marketing job at an advertising association. This threw the deal into jeopardy, despite her husband's work as the owner of a zoning consultancy practice and the extra income they earned from a rental property. Erica had been planning on striking out on her own as a consultant and had picked up a few clients, but the pandemic and layoff threw her off her timetable. Her lender would not factor in her consulting income as she hadn't yet established those earnings for 2 years. We really scrambled a lot to save this deal, says Erica. They wound up dipping into their 401k accounts to come up with a larger down payment, about 40% of the purchase price, to satisfy their lender. Last week, they closed on the property. Lawmakers recently allowed folks to take out up to $100,000 from their 401k accounts due to the crisis. They have 3 years to repay it before facing the typical early withdrawal penalties. The unemployment picture has definitely gotten a lot worse and quickly, says MBA's Ken. This is one of those economic events where we really don't know when it's going to be over and when things are going to go back to normal. Now, I want to mention that yes, a lot of the lenders are tightening up their criteria, but there are some lenders out there who are still going on as business as usual. I even know one lender who is willing to provide you with a 100% conventional loan, which means that you don't have to put down any down payment. So that's great, as long as, of course, that you make it through their criterias, which is not a lot. Um, so if you are thinking about buying the next 3 to 6 months, and you are timid about what's going on right now, I think this article explains things pretty well. Now, if you feel like there's some items on your credit report that needs to be addressed, now would be a great time to have a lender or a credit repair expert take a look at it, and to kind of help you navigate to clean up that credit report, so that when you're ready, nothing will stop you to get to your home buying process journey. So I do want you to keep that in mind. And if you want to buy right now, yes, most lenders have tightened up their criteria, but I do want you to know there's also some lenders um, who are still who still have some flexibility and can work with your situation. So if you have any questions, you are welcome to give me a call, to reach out to me, and I will be happy to point you out to the right lender or credit repair person. Now, I hope that you like this video. I hope that you found this useful. Feel free to share, like, subscribe, and comment. And until next time, bye.